Hey, welcome back. It's JWalter here, and here's your latest housing market update. According to the Mortgage Bankers Association, or the MBA, they reported today that mortgage application numbers have fallen to the lowest levels since 2018. This is also during a time where mortgage rates have been decreasing, so it's very telling that we have a decrease in mortgage application numbers, even though we saw a decrease in mortgage rates. So that's the topic of today's video. Let's go ahead and dive right into the video. And of course, if you guys get any value out of today's video, then please hit the like button. I greatly appreciate that. And with that said, let's go ahead and dive right into the video here. This is according to the MBA again, the Mortgage Bankers Association. They just reported this today, which is June 1st. They say mortgage applications decreased 2.3% from 1 week ago. And this is for the week ending May 27th of this year. So again, they break out mortgage application numbers by refis as well as purchases. So obviously the refi index fell from 1 week ago. It also fell 75% from the same week 1 year ago. No big surprises there given the fact that mortgage rates in general have been increasing greatly over the past year. However, the unadjusted purchase index, which is an index that measures the amount of home buyers submitting loan applications for home purchases, that actually decreased by 2% compared to the previous week and has fallen 14% compared to the same week 1 year ago. And according to Joel Kahn, who's one of the associate vice presidents at the MBA, he stated the following: mortgage rates fell for the fourth time in the last 5 weeks as concerns of weaker economic growth and the recent stock market sell-off drove treasury yields lower. So what we're seeing right now is a sell-off for stocks. The stock market has been tanking greatly this year. So here's the latest trends we have for the stock market. The Dow Jones is down 9.2% for the year. The NASDAQ is down almost 23% for the year. And the S&P 500 is down approximately 13.3%. So we're seeing a lot of volatility in the stock market, which is causing some people to park their money in treasury notes. What that does is when there's a lot of demand for treasury notes, that actually causes the price of those notes to increase, which drives down yields. So in other words, the price and yield are inversely proportional, right? So let me share this with you guys. Here's a yield on the 10-year US Treasury note. So as you can see here, the yield on it as of the middle of May or May 16th was approximately 3%. But as you can see here, over the past several weeks, the yield has been decreasing. This is because people are moving their money to treasuries, which is causing prices to increase and yields to decrease. So the prices to yields is inversely proportional. So when prices increase, the yield decreases. And as you guys all know, the yield on the 10-year US Treasury note is tied loosely to mortgage rates. So when the yield decreases, so can mortgage rates. So in other words, because we're seeing this volatility in the stock market, this is causing the yield on the 10-year US Treasury note to decrease, which is causing mortgage rates to decrease. However, you would expect that mortgage applications would increase when mortgage rates decrease. However, we're seeing just the opposite effect here. Mortgage applications decrease to the lowest levels since December of 2018 as the purchase market continues to struggle with supply and affordability challenges. So even though mortgage rates have been decreasing, we're seeing a decrease in the number of people submitting loan applications for purchases. So as you guys all know, according to the Mortgage News Daily, the average 30-year fixed rate mortgage reached highs we have not seen since approximately 2008, when mortgage rates on average reached 5.64%. But ever since then, mortgage rates have been decreasing basically through the end of May. And that is tied loosely to what's been going on with the yield on the 10-year US Treasury note. So as of the middle of May, the Treasury note or the yield on the Treasury note has been decreasing, and that is tied loosely to what we're seeing for mortgage rates. So as you can see here, mortgage rates have been decreasing really ever since the beginning of May and have fallen greatly ever since May 27th. And you can see this decrease in mortgage application numbers when looking at this graphic here. So ever since really the end of January, the amount of people submitting loan applications for purchases, which are measured by their purchase index, has basically been falling since the end of January. And besides the onset of this pandemic, we're currently at the lowest levels we've seen since December of 2018. So as you can see here, the purchase index has been falling greatly ever since basically January of this year. But right now, excluding basically the beginning of 2020, we're currently at the lowest levels since approximately December of 2018. In any case, going back to this report here, purchase applications, again, they fell 14% compared to this time 1 year ago. However, we're seeing more activity for larger loan sizes. So Joe Kahn goes on to say the following here. Demand is high at the upper end of this market, and supply and affordability challenges are not as detrimental to these borrowers as they are for first-time home buyers. So in other words, what he's saying here is that housing affordability is more of an issue for first-time home buyers than people who are buying on the upper end of this market. As you can see here, take a look at this. This is according to the National Association of Realtors. Here's the percent change in sales or home sales from 1 year ago by price range. This is the most recent stats we have, which is, I believe, for April of this year. So as you can see here, again, this is the percent change in home sales from 1 year ago by price range, and this is for the US as a whole. So as you can see here, compared to 1 year ago, for houses that sold for less than $500,000, we're actually down compared to 1 year ago. I mean, look at houses that sold for less than $250,000, down over 23% from 1 year ago. Houses that sold in the range of $250,000 to $500,000, down 5.2%. However, look at the upper range of this market here. So in this price range right here, up 19.3% compared to 1 year ago, and houses that sold for over $1 million were up 16.3% in the number of home sales compared to 1 year ago. So in other words, these home buyers looking to buy houses over $750,000 are not as impacted by these affordability challenges with rising mortgage rates. However, I definitely want to mention one thing in this graphic though, because the median sold price in the US right now is just under $400,000, according to the National Association of Realtors. They just announced that a couple weeks ago. Therefore, it definitely makes sense. We're seeing a big decrease in the number of houses that sold for less than $250,000, given that the median sold price in the US is approximately $400,000. However, though, people looking to buy an entry-level home or first-time home buyers are really impacted by high inflation and, of course, rising home prices and rising mortgage rates. So here's another report from the Mortgage Bankers Association that I also want to share with you guys regarding housing affordability. It says here, rapid home price growth, low inventory, and an 80 basis point surge in mortgage rates, that's by 0.8%, slowed purchase applications in April, with a typical borrower's principal and interest payment increasing $153 from March. So in one single month, the average home buyer is going to have to pay $153 more for the average price home in the US from 1 month ago. However, compared to 1 year ago, that's a surge by $569 from 1 year ago. So to basically buy the same house 1 year ago, it's going to cost the average home buyer $569 more per month to buy that same house from a year ago. And it goes on to say the following here. Despite strong employment and wage growth, housing affordability has worsened since the start of this year. Of course, that makes sense because mortgage rates have been increasing greatly. And of course, we've reached all-time record highs for home prices as well. It says mortgage payments are taking up a larger share of home buyers' incomes, and sky-high inflation, which is basically at 40-year highs, is making it more difficult for some would-be buyers to save for a down payment or come up with additional cash they need to afford a higher monthly payment. And by the way, they updated their forecast for 2022. They're now calling for mortgage rates to remain above 5% for most of 2022, but prospective homebuyers should start to see moderation from the double-digit price appreciation reported for well over a year in most of the country. So in other words, they're forecasting for mortgage rates to remain above 5% for most of 2022. However, we're not going to be seeing this big increase in home prices like we saw in the spring months of 2021. And because of this housing affordability issue that we have, more and more home buyers are looking to use adjustable rate mortgages or ARMs in order to buy houses, as have been important to you guys for several months though. So according to latest data though, this is again according to the Mortgage Bankers Association, the adjustable rate mortgage or ARM share of activity decreased to 8.7% of total applications. Again, this is the latest trends we have as of today. As I've been reporting to you guys over the past several months, the share has been increasing. However, over the past several weeks, it has started to decrease, which is a positive sign. So at the beginning of this year, the share of ARM activity, or the share of people submitting loan applications for ARMs, was approximately 3%. Then it skyrocketed all the way up to about 11% from a couple of weeks ago. But it's great to see that that share has been decreasing, now currently at 8.7%. The reason for this is that the spread between the 30-year fixed rate mortgage and a 5-1 ARM, for example, has been narrowing. So about 3 weeks ago, the spread between a 30-year fixed rate mortgage and a 5-1 ARM was over 1%. However, that spread has been decreasing. So have a look at this. The average for a 30-year fixed rate mortgage is at 5.33%, and this is for people putting 20% down. In other words, 80% loan to value. 80% is a loan, 20% their down payment for their house. However, the average mortgage rate for a 5-1 ARM is at 4.46%. So in other words, less than 1% compared to the average 30-year fixed rate mortgage. So in other words, because the spread has been narrowing, it makes sense that less people are submitting loan applications for ARMs. So comment below with your biggest takeaways from today's video. Hope you guys have an awesome day. Look forward to seeing you on the next video.